What's the outlook on future asset prices as global liquidity is reduced from markets? And how does Aziz and the team view the impact of reduced global liquidity on the portfolio's companies in terms of valuations and earnings power?
Aubrey, you want to take that one?
So I've been reading a book at the moment called Scale by Geoffrey West. And there's a fascinating little bit about Brunel and started talking about turbulent flow. And I realized that that's actually quite similar to the markets. That turbulence that you see in water, when you have momentum of water, okay, I'm not going to explain it very well, but you get movement at orthogonal angles. And there's this mathematician called Reynolds who came up with a way of predicting turbulence. Now, I'm not saying I can use this as a trading strategy, but just the principle actually is quite analogous. That the more viscosity, the less turbulence you get. Yes. And the same applies to liquidity and momentum of markets. Now, so the problem is when you have reduced liquidity, you're going to get more turbulence in the markets, but this is orthogonal, it is not directional. It could be, that could go up, it could go down, and it's not our job to try and predict that, but it is our job to try and prepare for that and to have a portfolio which is balanced in a way that will benefit whichever direction that happens.
No further comment. I've been waiting to say that. Actually, I do have one thing that I think is worth mentioning on this. It relates to the second part of the question. So, two people ask essentially the same question, but the second one is slightly different. So, I think the first level impact is the impact, like you said, on the market itself, which is the literal question. But I think there are secondary impacts that could still make a difference over a longer period of time. And so, if you think about it, so the literal lack of liquidity in the securities themselves is going to cause more volatility, like you said. That's the main and most obvious impact, and the one that's most immediate. However, if we do have a prolonged period where there's reduced volatility, then there could be secondary impacts on the flow of capital into equities, all kinds of equities, whether listed or not. In a sense, investors will price in higher volatility and demand probably a higher return, which means that from a discounted free cash flow point of view, you're now discounting the free cash flow of these underlying companies from now until Judgment Day at least a slightly higher WACC, which means that you do end up with lower stock prices, holding everything else equal, of course. The economists speak. And then if you do have that, then the third effect could be the reverse of a wealth effect, which has been more pronounced historically in the United States, where people own more equities either directly or through their 401ks, which could then impact consumer spending and eventually impact GDP, but especially consumer spending in the United States, I think particularly. Now, if you've seen the number of steps that I've gone through, there's an if in every one of them, and then there's a holding everything else equal in every one of them. And so take that with a grain of salt. But I think the immediate impact is exactly what Aubrey said on the volatility. And I think for us, we've always said that our strategy does better in more volatile markets. We weren't really sure that that's true. But this year, when we did have higher volatility, it really did kick in and show that it does actually work. And so the lessons from how this strategy performed in the fund since inception, but even in my old fund, closed-end fund from 2003 to 2011, whenever you have higher volatility, our type of strategy works better, or at least works best relative to other periods in time. And when we have cash like we do now, this is where we can actually add value as active managers. I really don't think, not just us, any active manager can add much value in a world with low volatility.